The first thing I want to say as we talk about emotions is emotions sometimes get a bit of a bad press. It's really important to understand that actually emotions are a necessary part of our decision making. We can't function without them. So we shouldn't fall into the trap of thinking emotions are bad, somehow we've got to eliminate them and then people will make good, rational decisions. I'm just thinking, for example, of the example of driving to work and a child runs out in front of the car. It's that sudden surge of fear that enables you to spot immediately that there's something going wrong. You've got to take action immediately. It's really, really important you react quickly. All of your cognitive resources get focused down on that one task. You know, similarly, we know that when people are in receipt of large amounts of data, that often it's their emotions that spot the pattern before their more rational thinking does. And that your emotions give you quite important cues. So we're talking to lots of very high-performing traders. One of the things that they talked about is about the way in which they use their emotions. The interesting thing was that actually the traders who were the top-performing traders versus the more modestly performing traders, there are no poorly performing traders who've been there a long time, they tend to get weeded out. But the big difference between them was not whether they talked about having intuitions, but how they talked about them. And the ones who talked, the really top traders tended to talk about the ways in which they brought their intuitions into their critical awareness and brought them alongside other kinds of data.
I'm just going to move to Joe Rundle here, because you're very much involved in trading for your company. And do you have any foolproof tips and advice to traders from your experience of how they can manage their emotions?
Well, unfortunately, there aren't any foolproof methods, but I do agree with Mark. Emotions are very important. What I find is that you need to have discipline around those emotions. I find it very useful to always evaluate why you've done a trade after you've made that quick decision which is based on emotion, and write it down. And therefore, when you then get caught up about the trade going offside or against you, or when it's going in the money, you can then refer back to that and you can have the rational decision to then look back at and see whether the emotions of the current moment are correct. So I think they're hugely important to have discipline, but wrapped around a set of emotions to help you make that quick-paced decision.
Do you think that, it's a bit of a cheeky question, do you think journalists have always got it right when they've been reporting on these financial crashes? Have they focused on the right things, on leadership and banking, that sort of thing?
But then, isn't the great thing of the past 5 years, the lesson we've learnt is that we're all idiots? You know, I mean, I've sat here thinking to myself, you know, we can all agree in this room, everybody, you know, whether you're serving the water or, you know, anyway, we all agree we're irrational. What I was intrigued about when I read the professor's research yesterday was how we learn from the lessons, because I assume that's why we're all here. And the professor, you say in your research that a third of feedback actually makes things worse. It actually, performance falls. And if that's the case, then how can you possibly use that feedback in any sensible way?